Hi, this is Randy Finney with Right Side of the Chart, and this is a mid to latest session update for Thursday, August 29th, 2024. It's 2:48 p.m. Eastern Time. I'm starting the video, so we still have a little over an hour to go in the trading day. I told you I'd get at least one more out to you today. I want to start looking at a few sectors here, and I mentioned looking at the financials. Probably a good time to do that. I don't know if these were coincidence, but quite a flurry of posts in the last 2 days, or comments, I'm sorry, a flurry of comments in there. Most of them are just comments on the market, but the usual stuff. We had Nvidia was down and has been down since earnings, and yet the Nasdaq was up today. And somebody commented about that. There were actually a few comments about the Dow making a new high. I'll start there real quick, just to give you analysis of the Dow. Now, you've heard me say this many times. The Dow is a super antiquated index that it's just, I've said this for years, to this day it baffles me why they even mention on CNBC. For those of you that are not familiar, it was created back in the late 1800s by Charles Dow and his business associate Edward Jones. Again, it's a super antiquated index, means virtually nothing. It's a basket of 30 stocks is why, and 30 stocks is far from indicative of the U.S. economy or anything else. Now, there are big cap companies in there, and it's going to roughly follow the S&P. But on that point, too, I've made clear many times recently my preference when I called for the top a few weeks back, a couple months back in June. It was on the Dow and I'm sorry, it was on the Nasdaq 100 QQQ, and made it very clear, even though I gave you targets on the S&P 500, that QQQ was and is my preferred shorting proxy for that because of the overweighting in the big tech stocks that I believe led things up on the way up and would give you more juice on the way down. So from those bearish engulfing candles to the lows that we covered the morning of August 15th, and then let's not forget reverse there, 15% drop when you look at the S&P 500. Remember, which is grandma's index, I call it, chock full of dividend paying, high-yielding defensive issue stocks, utilities, healthcare, less than a 10% drop. So we outperformed the drop in the S&P by over 50%. That's very well worth it. The Dow, let's see, the Dow, antiquated Dow dropped 7%. So okay, just so to make that clear, I haven't seen anybody, even in the comments section on the site, mention being short the Dow. But let's talk about the Dow. It is they are a basket of important stocks. I'm just going to move over so you can see what's in there for those of you not familiar. Here's the components of the Dow. It's got a couple of the same top components, but missing a lot of tech and big names that really are making up the drive in the market today, such as Nvidia, not to mention quite a few others. All right, so that's it. This is what it looks like on my day. I updated the chart now. This is almost looks like it is pretty much a broadening wedge pattern. You have an uptrend line here. The broadening wedge, they would call this an ascending broadening wedge. You can look up that pattern, ascending broadening wedge pattern. And you've got your 1, 2, 3 distinct tags on the top, 3 on the bottom. You have an uptrend line right here, and what you do have is very clear and solid divergence. So it's a new high, and it's a high that I put good money on will fail, meaning will fall back below this previous high. So again. All right, I had to stop the video there for a distraction, interruption, but I'm back now. This is just kind of a quick mock-up. It's a little bit of a busy board, but what you can see here, this, other than the potential broadening wedge pattern, you have this divergent high right here. Big divergence. Even you can see it steepening here on the latest thrust up. All starts off this point here. We have equal and then steepening divergence. Really from that point, you can even take it back all the way here. That's really where it starts from, and that shows through better on the weekly. So this was COVID. That was in the S&P, I know it was 36% drop. Again, very much priced into the charts with a bearish rising wedge to trigger it. This was the big drop in 2015. I'm on a weekly chart, by the way, just showing you the weekly highs. There was the bear market, the divergence leading up to the bear market in 2009. You can also look at DJI. DJI is the index itself. There it is. That was the divergent high right there leading into the. So as you can see, without fail, when you get these divergences here on the weekly chart, they build for at least months and quite often a period of years, and then ultimately they play out. And again, this is really, and I'm still viewing it as the, the start right there and the big kickback rally that's taken us to a marginal new high. Again, semantics, whether you want to call it the first leg down in one bear market. A lot of indexes have made new highs, but most stocks haven't. So it's, again, the same, overweighting, multi-mega cap, the few trillion-dollar companies we have, Apple, Microsoft, Amazon, these guys, they're also they have that same effect on the Dow, which again skews it. My point is it skews it as a unrepresentative index of the entire stock market. But that's it. If you want to look at where it is and you want to trade it, that's the Dow. And again, when we zoom back in to where it was, this is right now, TIA. This is the most recent divergent high, and here's your uptrend line. So if you want, okay, so what's the point? Divergences are in sell signals. Well, we get a solid break below that trend line, that will be, and that will bring us back down. So now let's go to the update on the equity markets, and we're going to get to the financials. So QQQ this morning, I told you, kind of a wait and see day. I'd love to see how the day finishes. We're up pretty good earlier this morning on the NASDAQ 100. And I said, don't read too much into it, but yet there were 21 posts that almost excitement from some of you folks that, in hyperbole, like bears are getting killed and all that. And, I'm good on all, my NQ shorts today. I'm positive, earlier was underwater. But what's happened since, I wanted to show you, is this. There's that downtrend line I highlighted this morning. There's the breakout, and it nothing but failed. And again, because it's all about NVIDIA. NVIDIA has been sucking wind all day. No buyers stepping in. The stock's been drifting lower, still under pressure. And my guess is it's just caught up with the market right now. They're seeing that the leader, if in World War II, the snipers, they tried to take out, if you can take out the generals or the officers, the troops panic. And that was a strategy then, and has been throughout, I guess, in modern history. And so NVIDIA is the 5-star general right now. And we'll see. It's not, you can't write it out. Today's only day one after earnings. But this in itself, and I was tracking it closely on the futures as well, NQ, this is that uptrend line, same the downtrend line I gave you on QQQ, which was popped this morning. And there's that uptrend line I gave you there. And so there was a breakout, and you guys have heard me say it once. If you've heard me say it once, you've heard me say it 1,000 times. Fewer things are more bearish than a failed breakout. So that's a failed breakout, followed by a break of the uptrend line at the same time. Pretty impulsive move down, and we're red at the moment. There's an hour to go. Maybe they'll ramp it up. But now if they do ramp it up, remember, we've already had a failure of this trend line. And what I would say at this point in time, and just, we're playing the near game right now, the short game, like in golf. You get up on the green, that's the short game. When you're teeing off, that's your long game. And so in long game are those longer term targets I have on QQQ, and the call that I still think that the early July bearish engulfing candles mark the top. But right now, this is what the bulls want to see happen. This would be a net bullish event. You have several reaction highs here. That level is at, if you want to replicate these charts, right about 19,000. We'll call it 19,700. It's close there, and that's a level to watch. Otherwise, we just broke down, and then I jogged back out to the 60-minute chart. That's the one I gave you this morning right there. There's the downtrend line that was popped this morning, but has now failed. So we're back below there. And so now this divergent high is, for a lack of a better word, kind of the overriding factor right now. We're just fresh off. Remember, this was the wedge right here. We were wedging higher. We broke down. We've been zigzagging lower. The fact we got rejected at that level, that level I just showed you here, let me zoom in a little tighter. What it does, and it's nothing huge, but for the time being, it keeps this near-term downtrend intact. Again, a downtrend being a series of lower highs and lower highs and lower lows, right? And that's what we have there so far. And the fact that when we rallied up, we didn't take out that previous reaction high. Now, so what do you need to do? We need to take out that recent low. And of course, you can see all the other levels here. You can replicate these are support levels on the chart. I may have to tweak some of these. These lines have been on here from before, but this is really kind of this level here. If we get down there and take that out, this is a level that I think will do the trick if we get that far down. Meaning do the trick. The lows, as I said, that's kind of like we'll seal the deal, lights out. But I think if we get anywhere to the recent lows, as I've been stating, you'll start to see the selling accelerate, stops being hit, and the selling just kind of take us down on through and right below those recent lows. And the S&P 500, much more relevant than the Dow, so it is one I watch as well. And the same story. This was our primary uptrend line right here. We're wedging up, put in a divergent high. We had a breakdown. We've been zigzagging down, and we stopped. You can see this 56, 61, 30-ish level. I'm going to zoom in for you. Is a pretty key level. I've been watching here on the 15-minute chart today because that's where we've been capping out lately. That's been the highs. We rallied into it and a pretty hard sell-off. Pretty impulsive rejection. And in one fell swoop, we also, after the rejection there, we took out that comparable near-term uptrend line. So that was, if you're an active trader, those are the lines you want to look at. These long, short-term uptrend lines on the 5, 15, 30 and 60-minute charts, anywhere in those time frames. And as you can see here, so kind of a little bit bigger picture going back to mid-August is this trading range we've been in here. You can see I have a midpoint of the range. And that's quite often the case when I see a sideways trading range or a price channel, if it's upward sloping like that or downward sloping. Very often, almost all the time, I can put a line right about in the middle, not just a random line. It's this one you can see it's support. Once broken, it was resistance, and we took it back. We go to the top of the range, support. So you trade either on the top of the range, and once you break it, usually, not always, but usually you go back down to the bottom of the range. So you can see we've been bouncing on the top of the range along the midpoint. We took it out there. We visited the bottom real quick, shot up. We took it out, went right to the top, because that's also the case. When you break the midpoint, you tend to go to the top. And so I'm watching this. We're right now on it. As I do the video close enough, you can, here, I'll show you. And so there's just kind of little micro levels. If you guys are interested, these are the things I watch. And so if by the end of the day, if it can't hold this level right now and this visit down to it, we'll probably end up going down and closing here today or tomorrow. If they can defend it, then, as long as we're above that, that increases the odds to go to the top of the range. And then, by the way, of course, a breakout above the top of the range after so many tests is hard to spin as anything but bullish. It should be a bullish technical event, so keep an eye on that. Likewise, a break of the bottom of the range should be a bearish technical event and bring in some more selling. Okay, I'm going to start out with KRE. That's the regional bank sector ETF. That's the one I really wanted to get out today, but I think it's also important to look at the financials. XLF, that has all the big banks as well as other non-bank financials such as Visa, MasterCard, Berkshire Hathaway, insurance companies, and the likes. This is just my 60-minute chart here. This was our last short. In fact, let me jump over to the daily. I just want to show you this is an uptrend line to watch. If we can push a little higher, it'd be nice. It'd be a better setup. To make an equal or slightly higher high would give us a wedge like this. So if we can do something along these lines, one more thrust up in here and give us some nice divergence and then get a breakdown, all the better. But trend line's a trend line, so a break of that should trigger. But let's look at the daily chart. And this is just a reminder to the, because I actually in a way feel bad for those that, are very vocal and almost angry about bearish calls and bearish things. Remember, this is a swing trading site. I've reiterated for a long time my longer term outlook from both the macro, fundamental perspective. The odds of a recession, in my opinion, being very high at this point. Imminent recession, also where I think the market's going, where big stocks like NVIDIA are going. And I know most don't want to hear that and they almost get angry, but remember, again, first and foremost, this is a swing trading site. So let's, if you recall, just back here a couple months ago in July, I highlighted regional bank sector. It's time to short this one again. We've had quite a few, over the years, short trades on the regional banks. KRE is the ETF for the sector. And back then in the videos and multiple updates, I was saying there's a resistance zone from 55.60 to 58.27, and that would be an objective short entry with a pullback minimum target down here, right? And these are additional targets, and they're still targets now. That's why I'm doing this video. We're back into the zone. We went above the zone by a whopping 1.8%. So you're talking, and then, but so far, what my point is, well within any, even a very tight conservative stop parameter. So that trade was still very much intact. And if you recall, because I have to continue to remind folks here, it's the way you read the front page posts. It's just gaslighting other folks. On the morning of August 5th, right there at the low, right here, I stated emphatically closing all longs, all short trades, and all accounts going to a hard long, full long position. And so this is swing trading, guys. From shorting here, even if we go from the lowest point, that was a gain of, and it hit the price target too, 11%. And if you go from the top of the zone, or so if you split the difference, if you averaged in, that was a gain of 13.2%. So again, swing trading. Go short, make 12, 13%, cover, go long if you want. I didn't go long the regional banks, but you could certainly have gone long the regional banks then, and you can short them again now or on a break of this trend line that I just gave you on the 15-minute chart. And now you have a reaction high here. Again, it's relatively close within the range, and you could have a stop somewhere there. If you recall, one of the reasons we had big negative divergence building here on that last high. If we pop now, the way this works is it's just been the market's MO for years, even when a sector is top. Remember, the regional banks are in a bear market, or at least they're not in a bull market. They're somewhere in between, because this is when they peaked here in the beginning of 2022, and they're still, as of today, down 26% below that level. So again, semantics, whether you want to call it a bear or bull market. But what the MO has been lately, for years really, and I think it's just due to the way that over the years the algos have figured out where stops are placed. You can almost expect if you get up near that high, they're going to pop it. So, and you would also extend this divergence line. So what I'm getting at is, although this is still a short objective short entry here in the zone, you could scale up to, or at least allow a marginal new high. It's still going to be, if it happens anytime soon, a divergent high, and then have your stops somewhat above that, right out of range there, especially if the divergence is taken out. Where to? Well, this was our first target before, first target zone, and so that's still another support level. It's been further validated with that last hit on August 5th, and in fact, we already hit it, and the divergence is larger, makes me favor this one. Another translation is, I would be less apt, I can tell you, if you get into it and you let it get going, maybe set a stop somewhere here as you start to approach this level. Probably have a reaction off it, but I would put good odds that the next move takes us down here, and that's going to be a drop of 22% if hit. All right, now I'm going to rifle through the components, and I'll do it pretty fast because there's a lot. These are, again, when I load the ETF, all the components are here. You can see on my watch list to the right there. And so back then, a lot of those stocks, as I did in the video at the time, were approaching resistance. That's where TFC, Truist Financial, hit, pulled back. And again, these are, swing trades, and they're quite profitable. That was also a 13% drop. See, now you have this larger wedge. You have a nice clean uptrend line, which you didn't have back then. So this wedge, like I said, can certainly develop a little bit more or not. It does. We already had a divergent high here. So as of now, kind of like the stock market on the June or early July, I'm treating that as a likely top, but very much open to this. Anything much more then starts to, you take away the divergence, and you take out resistance by a wide margin. You can allow for a little pop. Again, that's the MO, stop pops, but we may or may not get there. What I can tell you is, so it's more of a scale in right now, in my opinion. There's some momentum behind the market still. We haven't. I can't say with the utmost confidence that the rally off the August 5th bottom is over. I believe so. So I'll look at it as a scale in, maybe half up to half, 3/4, 2/3 of position there with the final lot added if and when this trend line goes. So I think I know I have price alerts on some of these, but not all of them. I'm going to rifle through the rest. So what we're looking for here, I'm going to show you my top picks if you want to trade any individual banks versus sector ETF. Because as I often say, find me a bullet. When I find a sector that's clearly bullish or clearly bearish, I can either go with the ETF, and it's easy, it's one thing, safety in numbers. You don't have to worry about earnings, which, by the way, with NVIDIA, we're pretty much now, earnings season's kind of officially over. There's always some tricklers at the end, but you don't have to worry about that too much. You can see these guys. This one doesn't report to the 17th of October. But or where I was going with, if you find in other words, a sector that I'm looking to short, then I can go and find the top 5 or 6 or 10 individual stocks that have the most bearish charts and go short those. And 99 times out of 100, I'll outperform the sector ETF if I get the call right on the sector, of course. So MTB, divergent high, there's where we shorted this one. This was all covered in in those videos. I gave you 2 targets. T1 was hit there. T2 was hit. Not coincidence that it was hit on August 5th, the day we covered all shorts and went long. And it was also believe the final target there that I would have given you back on July 18th. All right, so we have an uptrend line here, quite significant uptrend line. In the near term, it's just a very steep uptrend line. And again, it's just a matter of, is this a kickback rally? Either way, if I thought that was resistance before, the fact we had a big drop off there helps to further validate that as resistance. Okay, I'm going to go through the rest there. Huntington Banks, there's your uptrend line, same level we reversed from. This is that drop we just caught and then got out of. Same thing here. This one pulled back. So the difference between now and then is a lot of these I have some pretty clean uptrend lines starting to form. This one you can see here has it didn't hit like a lot of others resistance at that last high. My first and significant resistance level is just overhead about 2381. And so therefore, we currently have divergence, but if it wants to go up a little bit more, that divergence will very much still be intact. And so this one, for example, is a scale in from right here where we are, because I think a lot of eyes are going to see that. And again, watch this, watch the market, the S&P 500, watch the big financials I'm about to get to, watch the regional banks, watch KRE. If you see one after another rolling over, especially breaking trendline support, this one's probably not going to make it up there. Otherwise, if there's just a little bit, a percent or so left in these guys, that would be an objective short entry. So it's a tight scaling zone with an add-on here to a full position on the trendline break. And again, another way to do this, guys, even if you don't plan to trade any of these individually, but you like KRE, you like the safety of a ETF, the diversification, you want to see the more of these you see break down, the better the chance that a short on KRE will work, okay? Because if just 2 or 3 of these break down, the rest all hit support and rally and then bust on through resistance, it's not going to play out. This one I give you a sole target of the uptrend line on back here when we shorted it. That one dropped down 15-16%, hit to the button. And again, this was I moved it now, so it's going to say updated on 8/29, but you can see I created that line on put T1 on must have been during a video I was doing on the 18th, which was right as we were coming up here, right here, and that target was hit. T1 right here hasn't been hit yet, so there's one that still put in a divergent high. East-West Bank got a little trend line. It's walking up now, and there's your primary uptrend line. So these primary uptrend lines, these bigger, more significant trend lines, I'm going to tweak it. I need to come in and catch those lows. That's still a target, as is this 71 level, and then 63.57. But if these uptrend lines get taken out, that's pretty bearish. All right, I could go on and on and on. I'm just going to rifle through and kind of show you that I'm adding a lot of these uptrend lines, giving you these little wedges there. There's Western Alliance Bank Corp. You know what? I'm going to put a resistance line. I see a reaction quite a few reactions here, coming about right about where it hit now. There it is, right on that level there. And so that one's at resistance, called a resistance zone. You can see a little more upside. Either way, you have a nice clean uptrend line. All right, to go any further, I'm just beating a dead horse. It's the same thing. You can do the same thing on if you have TC2000 or whatever. If you have a charting platform that gives you the components, that's all I'm doing is hitting the space bar, and I go through all the stocks and I see similar patterns, just like back here. See that divergent high, uptrend line, breakdown, and the selling didn't stop till this point. You got the same thing now. Comparable, this looks almost identical. Divergent high, uptrend line, waiting for a break, and then those will be shorts. Let's get to the big financials, and then we'll wrap this video up. All right, so back here also at the same time, I was covering the XLF. That was this right here. We had a divergent high. We had a slightly higher marginal. There's a good example. If you look in real tight of a slightly higher. It was roughly equal. I thought it might have been a little higher. It's roughly equal, maybe a few pennies higher, marginal new high. And then you can see it went on to break the uptrend line right there. And boom. And when did it bottom? You got it, guys. August 5th. Cover all shorts, go long. That's what we did. And now we've come full circle. There's an uptrend line. Very easy to replicate this trend line off the August 5th lows. Lots of nice, clean, distinct reactions. Divergent high, but divergence is not a sell signal. What is a sell signal? A break of a trend line. So I believe I have an alert on that one. I'm pretty certain I do. If not, I'll have 2 alerts now. So you wait to see that break, and then when it breaks, I look at it. Is it an intraday break, or is it a solid, is it just a little whipsaw down through there? And then I'll look at the other components collectively. But I've added some levels here. First support that needs to go, or BOD support, 44.19. And then you can see all the levels, 42, 43, and I have this uptrend line. I may have added cents right here. So that would constitute a drop from where we're at now in the financials of about 7. And that would be based on this divergence, guys. Based on, this is the weekly chart of XLF, okay? You can see here, divergent high. I'm going to measure it out for you. The drop following that, there was a flash crash, 27%. Divergent high here. I have to move away a little bit. I have to start high and finish low, or I'll move the trend lines. That was about a 27% drop. Divergent high right before COVID. Again, call it a random event if you want. It was priced into the charts. We were short. 46% drop. You had a beautiful similar pattern here. You had a nice clean uptrend line. Divergence that had been building. This was really DH1 and this was really DH2 because it was simply an extension of the previous divergence. Smaller divergence, smaller drop, bigger divergence, bigger drop. Okay, everything was reset there. No more divergence. Bull run, rallied up, divergent high, drop. Divergent low, put in a bottom right there. That's a major support zone. It is also a target for me on the financials right there. See this support zone right here? Purple line with the white line there. And so what I can tell you definitively, just like this divergent high here that was followed by a drop of 28%, we have now, this is really DH1 and this is DH2 because it's the same divergence that started at this point has just grown larger, indicating that when we finally turn the corner and it's more than just a little correction and uptrend, that we're going to come on down and have an even larger drop. So even if we hit that same support zone, and you could see the purple line's what I favor, it's about $30, $30.20. That's going to constitute a drop from where we're at. If it happened, if we turn soon and we go higher, it's going to be a different number. About 34% drop. And you can see this is the primary uptrend line here. Let me extend that to the right and color it up. So that's a potential and likely target too. Color that purple as well. Okay, so that's the big picture on financials. That paints kind of how far we might go. This is more of the near term right here, that trend line, right, on the ETF. Now let's look at the top components. Same thing, we had a divergent high here on JP Morgan, and it fell into those August 5th lows by 12%. Yes, so again, guys, swing trade. Even if you don't believe the big targets I'm giving, you can swing these short-term targets. You make 12% in a week, turn around and go long. and then add another whatever to that. That's swing trading. You do that week in, week out, even once a month. You're gonna have a profitable year. All right, so there's the most recent divergent high, and there's the uptrend line in JP Morgan. Pretty important level right here, 216.31. I'm going to set an alert there too. Why is that an important level? Because that was a previous highs right there, and we were testing. There's 4 candles in a row after these distinct highs there, and this is a breakout. It is a breakout that I believe will fail. Why? Just because it has divergence? No, but yeah, that's part of it. Just because we're overbought, look at the RSI. Let's take a look here. Look at the volume. There's nobody volume. This is just drifting up on fumes. There's nobody buying this rally right now in JP Morgan. Just the last of the shorts recovering. So that's overbought right there on the RSI. And as I said, breakouts that occur with negative divergence and overbought conditions have a much higher rate of failing. We were overbought right here. What happened from there? Well, let's measure it for you. We hit our 70 level on the RSI and the stock fell, and we also had divergence 12%. We were overbought here. What happened? Well, we put in a big bearish engulfing candle, and from there we fell 7.25%. All right, so you get the point. It's not any one thing. It's a combination of multiple things there. And we want to play it safe, wait for the trend line break. Now let's just look at the rest of the lot. Visa has peaked back here after that bearish engulfing candle on March 22nd right there, and has been in a downtrend. It did pop this trend line today. It's not a super duper trend line. Why? Because I like to see 3 distinct reactions. We didn't really have a reaction on this one yet. We've come up and we went through it. A reaction is when you rally up to a trend line from below or above, and then you pull back, you have a reaction on it. I say that because any 3 points can be connected at random. Now, if we do get a reaction here, I'll validate that trend line. We do have a valid near-term uptrend line right here to watch off the lows. And remember, Visa peaked back here. It's one of the key tells of the economy. They have a very simple business model. Every time you swipe your plastic, they make 2.75%. Well, the bank that they're working with too, but so more swipes, more money they're making. This is supporting the case that things are slowing down, rolling over in the economy. But either way, we'll watch it. Needs to take out that trend line right there. I don't have a strong opinion on it. It's not one of my favorites right now. There's MasterCard. There's a comparable uptrend line still below the highs it put in here, and it had that bearish wedge breakdown. But remember, they put in these divergent lows recently, successfully tested the 200-day moving averages, and they're above that. So the magic number where you really want to see MasterCard to write it off is a break of this uptrend line off the October 2022 lows. That one does have some nice, clean, distinct reactions. Including this recent pullback here. That was a divergent low. It was a successful test after a brief stint below the 200s. As I said, it's more than common to see a brief couple days, week or so below the 200 days, and only to see them recovered. And so this is a big level that you might want to watch going forward, whether it's 3 weeks from now or 6-9 months from now. Set an alert on that uptrend line, because if you take out the trend line anytime soon, you'll have also taken out the 200-day moving averages. Bank America peaked here. Bloodbath sell-off right down to the 200 days on, you got it, August 5th. Hard reverse. This is the bounce that was expected. This is the bounce, the million-dollar question. Is that the best buying op in years? Are we going to new highs? Or is this only a counter trend bounce, reflexive bounce off the 200s, where I would have been shocked to not see them come in. We haven't visited the 200s in forever. It's been since we took them back here. This is the first test of the 200-day moving averages in Bank America since it recovered them after this bear trend where they were being capped by the 200s. And so they took them back. So it's just the first test. And it may go on. It needs to clear this resistance level right here. But near term, I'm not going to force. I'll draw an uptrend line there. I'll tell you, it's not the best. It's not super well defined. You've got a few reactions to recent low in there and there and there. So just keep an eye on that. But it's also, guys, it's well below. This is the primary uptrend line off the lows, and it clearly took that out there. So it can go up here and simply just be a back test. So if it does anything more than that, then it's going to take out that previous high. But remember, this stock, like many and the majority of stocks in the stock market peaked back here in late 2021 or early 2022, and it's still below that peak. And it also says, what's going on in the banking industry. JP Morgan's its own thing. Jamie Dimon, as you all know, he's a deity on Wall Street. He's like the old E.F. Hutton. When E.F. Hutton speaks, everybody listens. For those of you old enough to remember those commercials from the late 70s or early 80s, he's that way. He's got the ear of the president and everybody else. All right, Berkshire Hathaway. Look at that. Nice, clean, steep uptrend line in which to trigger. No sell signals now. And then this purple uptrend line is your primary uptrend line. I would definitely have an alert set there. I think I do already, but like I said, I'll go through these videos. I'll set them again. So the minor trend line will trigger a breakdown, and you can see first support / targets right here. Second would be that uptrend line, which we just recently checked. And then you have the 200-day moving averages below that. We haven't, Berkshire, if you look at, hasn't visited the 200s since back here. So that's the other thing about it. We had quite a few stocks come in and check the 200s recently. Berkshire, once we regained them here, that was all the tests. They bought it. So that would be a potential target as well, and a place to cover a short, possibly, depending on what everything else is doing. But right now, like I said, no sell signals, not even remotely close to a sell signal on the big financials. I have the regionals, as I showed you, approaching at resistance again. These guys, I don't. What the first thing you'd want to see, since they recently took out these highs, you'd want to see a failure. This being a false breakout and move back below there. That would be your first, we'll call it a high probability sell signal. Wells Fargo, breakdown and backtest in the near-term uptrend line. Still, like most banks, most financials, well off their highs. This is a big, big level right here. And you can see all my other resistance levels on that one. AXP, the best of the credit cards, the big three credit card companies. There's the uptrend line we're flirting on right now, so all you have to do is replicate that, set a price alert, and this is also a big holding in Berkshire Hathaway, along with a lot of big insurance companies like I think Progressive and some others. So that's it, guys. And the bigger picture is, look, this was the primary uptrend line that we recently broke right here. We had a divergent high, we had a sell signal there, right off the primary. This is the primary uptrend line. And so this is nothing right now more than a breakdown. Back test 1, back test 2. So if it goes up anymore and gets a solid close and gets above this uptrend line, well, then that's bullish because you've now regained that trend line. Otherwise, this is a breakdown, back test, and if we get rejected, well, this is the target we already hit, 211.36, and we would hit it again, and most likely then once we take that out, we take out the 200 days, a lot of thin air on AXP, a lot of thin air. This is a longer term target. I'd have to, look, most of you aren't going to take these anyways. I know that just from the board. But if you do, and you want the longer term targets on any individual one, some of you guys and gals are options traders, and I can give you long term targets, and that may help you. And also I always do my best to tell you when I think it might get there. That's the hard part, and that's why I'm not a big options guy. I'm traded them in the past. I've got some NVIDIA puts, like I told you right now, and plan to add to NVIDIA shares. I'm still holding off on that. I didn't add, even though we're down today. I told you I would add post after earnings, and I still plan to, but I want to see a little more. When I started out with the markets, I want to see us a little more downside, a little more confidence. I want to see us break some of those support levels I gave you earlier on NQ, QQQ, SPY, and ES. All right, so that's it. AXP, nice looking setup, and that's all it is right now, a setup pending a sell signal, which would come on a break of that line. Yeah, there are going to be some little stops along the way, like one right there and all that, but based on the scope of the divergences, my preference would be kind of a tuck it away swing short. If you get that sell signal, set your stop. In line stops should be calculated based on your price target. So let's just say you're only going for that 211.36 level. You're looking at a 15% drop. You could give yourself a 5% stop loss, and that's a 3-to-1 RR. That puts you a stop loss right up here, about 272, right? That's how easy way to calculate, or you can, if you get a break of the trend line, you can have a tighter stop if it regains the trend line. There's a lot of ways. There's, there are many ways to skin a cat, and they say, and there's many ways to set your stops and calculate them. And again, like I said, bigger picture, that's where I'd go to the weekly charts, study this, and try to figure out where this one's going before all's said and done. And I haven't really done that lately. I could probably put in a primary uptrend line right here and say that's a very likely target. And again, when it gets there, that's the $1 million question. But it would be something like this. If we break down soon, knowing that stocks tend to fall faster than they rise, it would be probably hit in 5 months, a drop of about 30-31% at least, if not, or I should say at most probably 5 months, probably even sooner than that. All right, guys, I'm going to leave the video with just two subsectors. So I covered XLF, the big financials, KRE, the regional banks. This is specialty finance. I don't believe there's an ETF for this. There may be out there. You could look it up, post it in the comment section. But the sector itself is IX 1520 on TC 2000. You have an uptrend line here that just broke. Big component there is Rocket companies. And that's Rocket Mortgage. And, so you have mortgage companies like that and all that. UMC, this one hasn't broken down. Rocket, as I showed you, just triggered a breakdown, a sell signal. UMC pending a break of this. UWMC, that's UWM Holdings is the name of the company. Mr. Cooper, mortgage processor. Right there, there's a key uptrend line, yellow. And let me show you a few more subsectors. You have IAI. This is the broker-dealer index right here. Broke this trend line. It's got some big divergence. You have companies in there, Morgan Stanley, Goldman Sachs, S&P Global, Schwab, a bunch of those. They're on my radar too. And then I had one more. What is it? It's KCE is the ETF, the Spiders S&P Capital Markets. Just similar to IAI, you have a lot of overlap, stocks like Morgan Stanley and whatnot. And this is what it looks like on a weekly chart. You get an uptrend line, big divergence there. And these companies are going to profit from a bull market, and they're going to go down in a bear market because they're obviously, again, I'm going to rifle through Morgan Stanley. Look at that, Morgan Stanley, beautiful breakdown recently, bottomed on the 5th, like everything else, ran up, and it's wedging. It's got this little bearish wedge as it's back testing the primary uptrend line. So that one's sell signal to come right there. And again, I just showed you an ETF that has things like this. So you have Morgan Stanley, Goldman Sachs. Goldman Sachs recovered its trend line, so you'd want to see a break down below it. S&P Global, look at that beautiful uptrend line, little wedge. Break of that's going to take you down to the, well, you can see where. I'll show you where. First target right there, that's 477 and change. I can't see, I think 30. And or the trend line, they may come in together when I say and or, because it depends. If you do that, you're going to come in together. And then a more powerful sell signal, if and when that trend line goes, takes us down to about 441. So just a nice looking setup. And again, if I don't have an alert, I do now on this. And I could go through these and talk forever. Blackstone, or BlackRock, I'm sorry, BLK, Schwab right there. Schwab's been sucking wind. Schwab's just, peaked way back here, lower lows, kind of in no man's land right now. KKR, a lot of these private equity firms. Oh, by the way, there's another one for you too. Going through a lot of private equity companies. They're also in an ETF called PSP, I believe. It's the, if I recall right, private equity, ETF right there. And they just recently broke this trend line here. They're back testing the downtrend line. If they fail that, then that may be it. And I'd have to go through those individually. These are all the private equity companies here. My charts. This one's back testing. Backtest. A lot of these rallying back into resistance. I didn't mean to go through these today. It just kind of my brain's firing tangentially. I wanted to show you some of those subsectors of the bigger financial sector and some of these little private equities I don't have marked up, as you can see here. All right, I'm going to wrap it here. We'll see where we finish today. Like I said, today, kind of a noise day, non-event. Nothing that really happens today from here to the close is going to change my outlook or anything, no matter how high up or down, whether we close green or red. It's kind of a noise post-NVIDIA day, but that's, that is worth noting that so far, despite the blowout quarter, shows there's no buyers on the other side of it, but I try not to read in any one day. But this is where, as I said yesterday, you take it, what happens in the after-hour session with a grain of salt. but the big boys, the starters, step onto the field. And this is institutional distribution. They can see, as you probably know, they have problems with their latest generation chip, some production issues. I read up a little bit about that. Here's an article if you're interested. Just do a Google search. It's from Fierce Electronics. What's wrong with NVIDIA's Blackwell GPU? They go into kind of detail the production problems they've been having with that chip and everything else. So that was mentioned in the call, and we'll see if that plays out. But either way, it's a story of all these companies when they do peak. And so far, this one peaked here. They peak on stellar blowout earnings, and what you're seeing is, yeah, they're still blowing the cover off the ball, but it's a deceleration in growth. All right, let me stop the video here. I'll get it out to you. This has been Randy Finney with Right Side of the Chart, and have a great day.